It is happening right now, not next quarter, not next year. Now, the global economy has entered a zone that every serious financial historian recognizes immediately, and that every mainstream financial commentator is professionally incentivized to describe as something other than what it actually is. The simultaneous convergence of 5 independent stress indicators, each of which has historically been sufficient on its own to trigger a major financial disruption, is now occurring in real time across every major economic bloc simultaneously. Not sequentially, not in the contained, manageable, one crisis at a time sequence that central bank intervention machinery was designed to address. Simultaneously, globally, in a financial system so interconnected that the traditional firewalls between regional crises and global contagion no longer exist in any meaningful operational sense. Here is the number that changes everything. The global economy is carrying $313 trillion in total debt against global GDP of approximately $105 trillion. That is a debt-to-GDP ratio of 333%. In every previous instance in recorded financial history where a major economy has reached a debt-to-GDP ratio above 300%, Weimar Germany, post-war Britain, Japan in the 1990s, the resolution has involved one of 3 outcomes: inflation that destroys the real value of the debt, default that destroys the nominal value of the debt, or a decade or more of economic stagnation so severe that growth gradually reduces the ratio through the accumulated sacrifice of an entire generation's economic opportunity. There is no fourth option. There has never been a fourth option. And the $313 trillion global debt load does not have a resolution pathway that does not involve one of these 3 outcomes at civilizational scale. The dangerous territory the global economy just entered is not a place on a chart. It is a place in history. It is the specific zone that appears in the final chapters of every empire's financial narrative. The zone where the debt accumulated to sustain the system exceeds the system's capacity to service it at normal interest rates, where the tools designed to manage individual crises are overwhelmed by the simultaneous arrival of multiple crises, and where the institutional confidence that has been the last line of defense against the recognition of structural collapse begins to crack under the weight of data that cannot be explained away by any narrative, however carefully constructed. The zone has been entered before. It has never been exited without massive pain. And the version being entered now involves numbers that make every previous entry look like a rehearsal. Let's establish the 5 simultaneous stress indicators with the precision their convergence demands. Because the convergence is the story. Any one of these indicators in isolation would be concerning but manageable. All 5 together represent a systemic stress configuration that the global financial architecture has never been asked to absorb simultaneously at current scale. The first indicator is sovereign debt sustainability. The United States is running a $2 trillion annual deficit, borrowing 25 cents of every dollar it spends. Annual interest payments have crossed $1 trillion for the first time in American history. Japan's debt-to-GDP ratio has reached 263%, the highest of any developed economy in history, sustained only by the Bank of Japan's ownership of 52% of all outstanding Japanese government bonds in the most extraordinary central bank balance sheet intervention ever attempted in peacetime. France is at 112% debt-to-GDP, Italy at 137%. The United Kingdom at 101%. Every major developed economy is simultaneously running fiscal deficits that are adding to already unsustainable debt loads at interest rates that are 3 to 4 times higher than the rates at which those debts were accumulated. The sovereign debt sustainability crisis is not a risk scenario. It is the current operating condition of every major economy on Earth. Simultaneously, the second indicator is banking system fragility. The $1.5 trillion commercial real estate maturity wall is hitting regional banks whose balance sheets carry fictional valuations on assets that cannot be refinanced at current rates. The FDIC's resolution fund holds $121 billion, mathematically insufficient to manage systemic regional bank stress at the scale the maturity wall will produce. The 8 major banks freed $2 trillion in leverage capacity through the weekend SLR modification, deploying that capacity into the most stressed asset categories rather than holding it as a prudential buffer. And the SVB-educated depositor base is sitting with mobile banking access and social media connectivity that can convert a visible vulnerability into a $42 billion single-day withdrawal at any institution whose exposure profile generates the question at sufficient scale. The banking system fragility is not a tail risk. It is the current structural condition of the American financial system, right now. The third indicator is currency system stress. The dollar share of global reserve holdings has declined from 73% in 2001 to approximately 58% today, a 15-point structural decline that represents the largest peacetime reduction in reserve currency dominance in modern financial history. The BRICS alternative payment architecture is processing an increasing volume of global trade outside dollar settlement. Saudi Arabia is conducting yuan-denominated oil transactions. Russia and Iran are trading in non-dollar currencies through SWIFT alternative channels. The petrodollar architecture, The 1974 agreement that made dollar demand structural by tying the world's most essential commodity to American currency is being systematically dismantled not through a single dramatic rupture, but through the accumulated weight of bilateral arrangements that each individually appear manageable and collectively represent a structural transformation of global monetary architecture. The currency system stress is not a future scenario. It is a current process with measurable trajectory and accelerating momentum. The fourth indicator is geopolitical energy risk. The Persian Gulf, through which 21 million barrels of oil and 77 million tons of LNG transit daily, is now covered by a Russia-Iran military alliance that has demonstrated operational coherence through joint exercises. American carrier groups are operating inside Iranian missile range. The Strategic Petroleum Reserve is at 1983 lows. A sustained Hormuz disruption does not produce a manageable oil price spike. It produces a $30 trillion derivatives cascade, as every financial instrument built on oil price stability assumptions faces simultaneous stress. The geopolitical energy risk is not a geopolitical abstraction. It is a financial nuke with a geographic trigger that is currently pointed at the most leveraged financial system in history. The fifth indicator is central bank exhaustion. The Federal Reserve's balance sheet peaked at $8.9 trillion after 4 emergency expansion cycles since 2008. The European Central Bank is at $8.8 trillion. The Bank of Japan has nationalized its own bond market. Every major central bank has deployed its emergency toolkit: zero interest rates, quantitative easing, forward guidance, emergency lending facilities, multiple times in the past 16 years. Each deployment has produced diminishing stabilizing effects and increasing side effects. The side effects: asset price inflation, wealth inequality acceleration, zombie company proliferation, pension fund duration mismatches, are now themselves sources of systemic fragility that constrain the central bank's ability to deploy the same tools again. The next crisis arrives at central banks whose balance sheets are already expanded, whose credibility is already questioned, and whose primary tools have already been used so many times that their marginal effectiveness has been substantially reduced. The central bank exhaustion is not a theoretical concern about future policy space. It is the current operational condition of every major monetary authority on Earth. 5 simultaneous stress indicators, each historically sufficient to produce a major financial disruption independently. All 5 converging at the same moment in the most interconnected, most leveraged, most confidence-dependent financial system ever assembled. To understand what this convergence means, to understand why this specific configuration represents genuinely dangerous territory rather than the routine cyclical stress that financial systems periodically experience and absorb, you need to understand the historical pattern that this convergence matches with disturbing precision. Study the period between 1925 and 1929 with the specific analytical lens of simultaneous stress indicator convergence rather than the single-cause narratives that history textbooks prefer. By 1928, the global financial system was carrying 5 simultaneous stress indicators that individually appeared manageable and collectively represented a systemic configuration that the architecture of that era could not absorb. Sovereign debt sustainability was compromised by the reparation structure imposed on Germany at Versailles and the war debt obligations connecting Britain, France, and the United States in a circular financial architecture where each debtor's ability to service its obligations depended on the economic health of the others. Banking system fragility was building in the American agricultural banking sector. Thousands of small rural banks carrying farm loan portfolios, whose collateral value had been permanently impaired by the post-war collapse of agricultural commodity prices. Currency system stress was operating through the gold standard's deflationary bias, forcing countries that lost gold reserves to implement contractionary monetary policies that reduced their economic output, precisely when expansion was needed to service existing debts. Geopolitical resource risk was embedded in the commodity price structures that connected colonial resource extraction to metropolitan financial system stability. And central bank coordination was failing, the Bank of England, the Federal Reserve, and the Reichsbank pursuing contradictory policy objectives that collectively produced the liquidity contraction that converted stock market correction into systemic collapse. The 1929 crash was not caused by stock market speculation. The stock market speculation was the visible expression of a financial system that had been accumulating simultaneous stress for 4 years while official reassurance maintained the confidence that prevented premature recognition. When the confidence broke, when the simultaneous stress became visible enough that the question formed at scale, the interconnected financial architecture of 1929 collapsed in a sequence that no individual policy intervention could stop, because the interventions were addressing individual symptoms of a systemic condition. The systemic condition required systemic resolution. The resolution took 10 years, a world war, and the deaths of tens of millions of people. The pattern is not that 1929 is about to repeat identically. The pattern is that simultaneous stress indicator convergence in interconnected financial systems always resolves through mechanisms that are more severe, more prolonged, and more politically consequential than any official projection made at the moment of entry suggests. The hidden financial force connecting 1929 to the current moment is debt deflation, the specific economic dynamic that Irving Fisher identified in 1933 as the mechanism that converted the 1929 stress convergence into the Great Depression. Debt deflation occurs when the attempt to service or reduce debt loads at the aggregate level produces economic contraction that reduces incomes and asset values, which increases the real burden of the remaining debt, which requires further deleveraging, which produces further contraction in a self-reinforcing spiral that normal monetary and fiscal policy tools cannot easily interrupt. Fisher identified debt deflation as the economic equivalent of a self-reinforcing collapse, a system that once entered, generates its own momentum toward an equilibrium that is dramatically lower than the starting point. The $313 trillion global debt load represents the largest potential debt deflation trigger in financial history. The simultaneous stress indicators are the conditions that could initiate the trigger, and the central bank exhaustion is the constraint on the primary tools that have historically been deployed to interrupt the spiral. The specific historical parallel that fits the current moment with the most uncomfortable precision is not 1929. It is the period between 1873 and 1896, the Long Depression, which financial historians now recognize as the first global debt deflation cycle in the modern financial era. The Long Depression was triggered by the simultaneous collapse of a speculative infrastructure investment bubble in the United States and Europe, the transition from bimetallic to gold standard monetary systems that produced a structural deflationary bias across all gold standard economies, and the credit contraction that followed the collapse of major financial institutions, J. Cook and Company in America, the Vienna Stock Exchange crash in Europe, that had been the primary intermediaries of the speculative investment cycle. The Long Depression lasted 23 years, not as a continuous collapse but as a series of recoveries that failed to reach the previous peak before the next contraction arrived, an economic environment of chronic underperformance, persistent unemployment, and political instability that created the conditions for the rise of the populist and nationalist movements that shaped the political landscape of the early 20th century. The current global financial system is not guaranteed to enter a Long Depression equivalent, but the structural conditions over-leveraged balance sheets, exhausted central bank ammunition, simultaneous multi-sector stress, and institutional confidence in visible decline match the 1873 entry conditions with a precision that should generate considerably more concern than the official narrative currently acknowledges. The concern is not that the worst is inevitable, it is that the institutional framework for preventing the worst has never been more compromised at the moment when it is most needed. Watch 5 developments in the next 90 days that will determine whether the simultaneous stress convergence produces a managed deceleration or an unmanaged cascade. First, watch G20 finance minister coordination signals. The 2008 crisis was contained at enormous cost, but contained primarily because G20 finance ministers and central bank governors achieved unprecedented policy coordination within weeks of Lehman's collapse. The current geopolitical environment, Russia sanctioned, China in strategic competition with the United States, BRICS developing alternative financial architecture explicitly designed to reduce dollar dependence, makes 2008-style coordination structurally more difficult to achieve. If the first signs of systemic stress produce national policy responses rather than coordinated international responses, the contagion pathways that coordination was designed to block will remain open. Second, watch the Bank of Japan's yield curve control policy. The BOJ is currently maintaining an interest rate cap on Japanese government bonds, artificially suppressing Japanese yields to keep the cost of servicing 263% debt to GDP manageable. This policy is sustainable only as long as the BOJ can buy every JGB that the market offers above the yield cap, a commitment that requires unlimited balance sheet expansion with unlimited balance sheet expansion, inflationary consequences if sustained indefinitely. When the BOJ abandons yield curve control, when the inflation or currency depreciation costs of maintaining the cap exceed the debt service costs of releasing it, Japanese bond yields will spike to levels that the Japanese fiscal position cannot sustain, and the unwinding of the $4 trillion in yen carry trades built on the assumption of permanently suppressed Japanese rates will transmit that shock to every asset class in every market globally within hours. Third, watch emerging market dollar debt stress. Approximately $8.3 trillion in emerging market sovereign and corporate debt is denominated in dollars. Debt that must be serviced with dollar revenues at a moment when the dollar is strong. Dollar interest rates are elevated, and commodity revenues are under pressure from global growth deceleration. When the first major emerging market sovereign, Argentina, Turkey, Pakistan, Egypt, reaches the point where dollar debt service requires a choice between default and economic collapse, contagion to other emerging markets with similar profiles will test whether the IMF's current lending capacity, $1 trillion in available resources, is sufficient to manage simultaneous emerging market stress at the scale that the dollar debt structure makes possible. Fourth, watch gold's behavior relative to Bitcoin and other alternative stores of value simultaneously. When both gold and Bitcoin are appreciating against fiat currencies at the same time, when the preference for anything that is not a central bank liability is sufficiently broad to drive appreciation across fundamentally different alternative asset classes, it signals a loss of confidence in fiat monetary systems that is broader and more structurally significant than any single asset's price movement suggests. Gold above $3,500 and Bitcoin above $150,000 simultaneously, both appreciating against a declining dollar, is the financial system's most comprehensive expression of institutional confidence breakdown. Watch for the correlation. It tells you more than either price individually. Fifth, and most critically, watch the Federal Reserve's communication for any signal of policy reversal before inflation returns to the 2% target. If the Fed pivots to rate cuts or quantitative easing before inflation is convincingly contained, driven by financial stability concerns rather than inflation control, it signals that the Fed has concluded that the financial system cannot survive the interest rate environment required to achieve its inflation mandate. A Fed forced to choose between its inflation mandate and financial system stability, and choosing financial system stability, is a Fed that has publicly acknowledged the debt trap. That acknowledgement, if it comes, will be the most consequential central bank communication since Nixon closed the gold window in 1971, because it will confirm what the data has been showing and the narrative has been suppressing, that the financial system has entered territory from which the conventional exit routes are all blocked. Here is the final truth, that the convergence of these 5 simultaneous stress indicators demands be stated without the institutional hedging that makes truths like this politically manageable but analytically useless. The global economy has entered dangerous territory, not because of any single policy failure, any individual institution's recklessness, or any geopolitical miscalculation that could have been avoided with better judgment. It has entered dangerous territory because of the mathematically inevitable consequences of 16 years of emergency financial management that deferred every genuine resolution of the 2008 structural crisis by transforming private debt into public debt, by expanding central bank balance sheets to absorb losses that markets would have forced recognition of, and by maintaining asset valuations through liquidity provision that the underlying economic fundamentals never justified. The deferred reckoning does not disappear through deferral. It compounds. It spreads through the financial system via the interconnections that the deferral created. It grows larger with every quarter that the structural imbalances are maintained rather than resolved. And it arrives not on any schedule that anyone can predict with precision, but with the inevitability of a physical law, at the moment when the institutional capacity to defer it further is exhausted by the accumulated cost of all the previous deferrals. That moment is not guaranteed to be now. But the 5 simultaneous stress indicators converging right now are the most reliable signal available that the capacity for further deferral is closer to its limit than at any point since the deferral strategy was first deployed in 2008. It is happening now. The question is not whether you see it. The question is whether you see it in time, to understand what seeing it requires you to do.